Thank you very much. It is a great pleasure to be here. I presented 9 years ago in 2008, in April, right before the crisis, the global financial crisis of 2008. And back then, I was presenting here about how the world is on the verge of an economic crisis. And it was really hard to believe because the world was booming. I didn't understand exactly what Aller said about Jim Rogers, right? And also, you should all be familiar, I guess, with Jim Rogers, are you? And with Peter Schiff, and with Mark Faber. And in 2008, in the second semester, from January till May, I was teaching in my class in investments and finance. I was teaching from using Jim Rogers and Mark Faber and all of these guys who predicted there would be a global financial crisis. And I was teaching a full course on the global financial crisis. And somewhere in about 5 or 6 weeks into teaching the course at the American University in Bulgaria, I had, by pure chance, got close and personal with one of my students with whom I was good friends with her dad. And she told me that students thought that I was crazy and nuts, that I had no idea what I was talking about. And I tried to explain to her that I've devoted, back then, 25 years of my life into finance and investments to teach them the course, and the students didn't believe a word of it. It took me 2 months of steady, heavy-duty education to really convince them that the world is on the verge of a global recession or a global depression, which indeed happened just a couple of months later. The global financial crisis began in September 2008. And now I'm facing a very similar situation in a world gone a whole lot crazier and on the verge of a recession or depression much worse than 2008. And I had for a while, since I was invited, I had for a while struggling coming up with a topic about my today's presentation simply because there's nothing to talk about. Financial markets are 100% manipulated. You look at the stock market, it has no meaning. The stock market is more overvalued than any time in its history. More overvalued than 1929 peak before the Great Depression. More overvalued than the peak of 1999. Real estate prices have gone crazy. Never anywhere in the West or in the East we've had so much overvalued real estate. It's even worse for bonds. Bonds, we have 5,000 years of recorded bond history and interest rates, and they have never been lowest. We saw just a couple of years ago negative interest rates. This is financial absurdity to have a negative interest rate where you lend money, you pay so that other people borrow money. Since ever, financial markets and lending existed, the borrower pays the lender. Now we've gone in a world upside down when the lender pays to the borrower for the privilege of bearing the risk of not getting their money back. I mean, it doesn't get crazier than that. Now, I have been, I think I heard some countries, I've been, since I was in April of 2008, presenting here in Estonia, here in Tallinn, 9.5 years ago. I've been working and living in 8 different countries. I've been working and living. I think he mentioned Saudi Arabia, spent a year. Then I was in Bahrain for 2 years. I spent a total of 4 months in the Philippines. Was working and teaching in Taiwan. From there, I went to Macau, spent 2.5 years in Thailand. Then the previous last year, I was in Cambodia. And I lived a little bit for 6 months back home in Bulgaria, and now I'm in Dubai, or nearby Dubai. And I'm coming from a world gone crazy. Very quick quiz. Tell me what you think. 2,000 euro per square meter real estate. Is it cheap or expensive? 2,000 euro per square meter. How do you feel? Huh? Oh! That was, I thought somebody's going to say, oh, it's cheap. Oh, no, it's expensive. The key question is, where? Well, I'm coming right now from Dubai. They think it's cheap, dirt cheap. They'll kill for 2,000 if they can find that kind of a deal. Well, I was last month in Dubai. I'm talking about October. 42 degrees hot. Damn hot. It's a desert. 7 months of the year, it's next to unlivable. Now, don't get me wrong. I mean, Dubai is amazing. Dubai is fantastic. It's great. You got 10-lane roads on the one side, 10-lane roads on the other side, and it's traffic jam. With 10 and 10, 20 lanes, it's still a traffic jam. Traffic is horrible, okay? Heat is horrible. It's expensive. Go there, it's shockingly expensive. And real estate prices are 4,000 euro per square meter. I mean, it doesn't get crazier than that. Well, what about 2,000 euro? 2,000 euro is in Cambodia. Phnom Penh. It's, how to describe it in proper English? It's a shithole. Garbage. Dirty. Stinking. You risk at any point in time extremely high crime. You're going to get robbed, you're going to get stabbed. Any kind of traffic crossing street, you risk of getting murdered, okay? Crime rate is horrible. Everywhere, poor people. I mean, you just imagine Mumbai or Delhi or something like that. Traffic, horrible. Traffic jams. You barely move with 5 kilometers per hour. Pol Pot made sure that there are big hole pots in the road. But roads just traffic. The concept of a stop sign doesn't register. You never stop on a red light. So it's a place you don't want to go and live. And it's a 2,000 euro per square meter. That's completely insane, okay? Now, I have prepared, and let me see, how do I go? Is there a button over here? Oh, all right. So what I've prepared is just to show you that what was going on in 2008 was bad enough. You should know simply because they call it 2009 and 2010 the Great Recession, which is considered to be the worst since the Great Depression. But now my topic in my presentation is that things are a whole lot worse now. Like just in 2003 up to 2007, you get to see this is global central bank assets and reserves were about $4 trillion. They have now gone up to 14 or so. In other words, since the credit crisis, global central bank assets and reserves have just about tripled. Essentially, what we've built for the last 100 years, in the last 7, 8, or 10 years, we've doubled it, or we've tripled what we've accumulated in the previous 100 years. Now, these central bank reserves will show up later as credit. Let's see what else I got. Okay, these are the balance sheet. And you can see balance sheet on a central bank by central bank. On the PBOC, and then the US Central Bank, and then the ECB, and the BOJ, and all of them. And you can see similar thing, about 3, 4 million. That's just a little different picture, all the way to 16. We are talking increasing 5 times. Now, normally, what's normal and healthy will be 1% or 2% in inflation and 1%, 2 or 3 on growth. So a normal, healthy growth of a central bank balance sheet should be just about 5% a year. A doubling of a balance sheet should take about 20 or so years, not a very short time like 3 or 5 years. And the ECB literally doubled the money supply in barely 18 months. Since the European financial crisis in 2011, the ECB has tripled, quadrupled its balance sheet in just 3 or 4 years. Again, this is totally, completely unprecedented in financial history. Let's see what else I got here. Oh, net worth. Okay, this is very interesting because household net worth is a very good indicator when it reaches a certain point as a percentage of disposable income, like 500 or so, you reach a crisis. So in 1987, that's the stock market crash, and you see it was 500%. Later on, the 1999 technology, internet, and dot-com bubble, you see the 2000 peak, it was close to 600. Then in 2007, again, that's a picture that I was using back then in my classes. 2007 greatly surpassed the 2000 peak. And of course, the crisis after 2007 was significantly worse than 2000. And now, as you can see, we're way beyond that level. Okay, so that's one very simple indicator to suggest that things now might be a whole lot worse than the previous crisis. All right, this is a very similar picture, but it's just a different graph. This is again the dot-com bubble, the housing bubble. Now it's literally everything bubble. And I already mentioned bond bubble, stock market bubble, real estate market bubble. Let's see what's next. All right, US real estate drove the global financial crisis. Anybody and everybody understood that the insanity in the US market spread all over the world, okay? It collapsed the global financial system, and now, just 10 years later, after the crash in 2008, it has recovered and gone even higher. It's like 10 years ago, the crisis never happened. It's like the crisis is completely forgotten. They use the same tools and techniques, the same methods, the same subprime, all the stuff that was happening 10, 11, 12 years ago is now going on just the same, and nobody's paying attention. And I don't know why. Prices are higher now. Now, Canada is way, way, way crazier real estate than US. Now you see the US is the blue. You see the crash here. Now the US is more or less recovered because this picture goes only 2014. 2014. But see what's going on with Canada. Canadian real estate's going up and up and up and up and up and up. And how do I know about it? when I was teaching in Phuket, you have tens of thousands of Canadians spending money freely. Hey, these are bubble money from real estate. And they're outspent only by Australians. We're going to get to that in a minute. Now, this is a slightly different picture. It's just showing the same stuff. It's the same idea up to 15. They've gone completely parabolic. It's one of the most expensive real estates in the world, probably somewhat more expensive in Sweden nearby. That's a different topic for another time. Now, UK crashed and burned. UK had a first Western bank run in over 100 years. UK banking system was totally, completely bankrupt. Well, just take a look at what happened. They went to the run-up in real estate prices, then they crashed, and now they're going way, way, way more expensive. British real estate. Now, where's this coming from? This is coming all money from China and Australia and Canada and everybody buying property in the UK. Now, the UK was a total and complete mess, okay? And now is way, way worse. That's why my original topic is worse than 2008. Let's take a look and see what else I got here. All right. This is a nice picture. Now, you see the U.S., and then you say, oh, U.S. is in great shape. Now, check out Canada. Canada is way worse, okay? Meaning, real estate is expensive. Now, look at Britain, way more expensive. And take a look at Australia. But nothing beats New Zealand. And again, this picture does not show Hong Kong. This picture does not show Macau. I got to live in Macau in 4 months, and it's crazy, okay? This picture doesn't show South Korea, of course, and Seoul, but it doesn't show Singapore, okay? Now, let me tell you how crazy is real estate in Singapore. Yeah?
Where is Estonia? Where is Estonia?
Well, I don't know. You guys will tell me. You figure it out. But I'm sure that it doesn't matter where it is. If the British American real estate or financial system collapses, Estonia is going to be affected just as much as the rest of the world. So Singapore, I mean, he mentioned it, I think, before, is totally, completely insane. Tiny little apartment is $500,000 US. Now, say you're a middle class person, okay? You're a middle class, you got a decent salary. The best you can afford with your salary is just about $200,000 US, all right? I mean, you're earning $3,000-4,000 US, maybe $5,000. You can't buy. It's impossible to buy. Now, you get a guy and a girl. One makes his money, and they're middle class or a little upper middle class. The one can buy $200,000. The other can buy $200,000. Okay, so they jointly can buy $400,000. Except one little problem. You can't buy. There is no property for $400,000. Property is worth $500,000. And the government now says, if you get married, you get a 20% government subsidy, and now you can buy the property. So guess what's happening now in Singapore? People arrange marriages in a 2-bedroom apartment so that they can get the subsidy and buy the apartment. That's their only way and only chance that they could ever possibly afford to buy an apartment in Singapore. Again, normal people with good incomes cannot afford it. Totally, completely out of touch with reality. Let's see what I got over here. All right, so far I tried in about 7 or 8 slides to show you the idea that real estate around the world is way, worse than what it was. Now I want to show you a couple of slides about stock market. The stock market isn't any better. And you can see you have the 66 peak, after which it had a 15-year bear market. Then you should have the 99 peak, and then you had for a while a bear market. Then you have the 2008 peak. It wasn't so great, but now, based on this particular chart, which is the margin adjusted price earnings ratio, it's called cyclically adjusted price earnings ratio, basically shows you some very simple idea. The stock market right before the Great Depression was that much overvalued. You're paying 40 price earnings ratio. Then in 1999, you were paying just about as much right over here. I wish I was taller. And now I can't possibly get that high. We have never seen the stock market, the US stock market, so overvalued in its entire history. The history starts or dates back since the Civil War in the 1860s. All right, this is a very similar chart, but it's using a different indicator, not the price earnings ratio, but the price revenue ratio. When you take the price of a stock to revenue, you see that historically, especially in the 90s, you got 1 ratio to 1, and 1's considered normal. Then you see in the 2000s significant overvaluation, and of course this is where the crash of 2008 is. Again, now based on this indicator, the stock market is way, way, way overvalued, significantly higher than the 2008 peak. So this is a different indicator showing you that the stock market has gone a whole lot worse since 2008. Now, taking and looking at Tobin's Q ratio and Shiller's PE ratio, these are separate indicators. Here is the Tobin's Q, that will be this one. And let me see, where's the Shiller's PE? That will be the blue one. And now you see what's going on. 1999, remember, market was highly overvalued. Now, according to these two indicators, the market is significantly more overvalued. Let's see. Oh, that's another interesting picture. All-time highs tells you how euphoric people are, how excited they are all over the stock market. This is when people are buying and buying like crazy. And the bigger the buying, the crazier investors. Well, in 1999, things went totally crazy with the dot-com telecom bubble. And you can see it with the peak of craziness at 61 days of peaks. Well, in 2017, we've already surpassed up to 63, and 2017 isn't over yet. We could hit another 5 or 10 new more, okay? So, again, this is a strong indicator that people and investors are very excited, and something's wrong with the stock market, meaning that the market behaves just the way it behaved before the crash of 1987, okay? Then before the crash in 1994, and then before the crash in 2000. In other words, it's a new all-time highs are a very good indicator of market excitement and usually a good predictor of a crisis. Let's see what else I got. Oh, European junk bonds. Get this. Now, if this is not crazy, you gotta tell me what it is. Now, let me show you what the picture says. This is European junk bonds, and this is the interest rate on a European junk bond, okay? And the interest rate here is on a US Treasury bond. And of course, if you're a junk company, meaning a very high-risk company in Europe, you'd be paying certainly a whole lot more than the US government. The US government is supposedly the most safe, okay? The lowest possible risk. Of course, you're going to be paying twice more, and sometimes 3, and sometimes during the crisis 5 or 8 times more. We have come to the financial absurdity where European junk bond companies are paying interest rates lower than the US government. In other words, the US government can now borrow at 2.3, and if you're a junk bond company in Europe, you can borrow at 2.2. This is absurd. Why would anybody in their right mind ever lend to an extremely high-risk company, European company, which is very likely to default at 2.2%, where you can lend it to the US government at 2.3? Makes no sense. That's why at first I had hard times making any meaningful presentation, just because the market, it doesn't make sense anymore. The market does not provide signals, and that's especially as they're getting closer and closer. In the last 2 years, markets don't provide meaningful information about returns or about profits or about risk, okay? Market has lost its signaling function, okay? Europe's non-performing loans. Again, look at just what Italy is. This should be a fairly old one. Italy's bad loans are gone to 350 billion euro. These are Italy. And then the second worst is France, okay? And then you can see Spain, all right? And again, these banks are bankrupt, completely and totally bankrupt. During the Great Recession in 2007 and 2008, bad loans in the US system were between 5 and 8%. And 8% bad loans was good enough to crash the global financial system. Italian banking system is estimated, official 20% bad loans and estimated 25. In other words, the Italian banks have, on a percentage basis, 3 to 4 times more bad loans. Well, that's the reason why Mario Draghi is printing money like crazy, and the euro is losing so much its value to the point where euro was worth $1.60, and just a couple of months ago it was worth $1.03. It was worth just $1. In other words, the euro lost 30-40% of its value. Now it's come back to 120 or so, but this is the reason. They have to print the money to bail out the bankrupt banking systems in Europe. And Greece, of course, is because on a relative basis, Greece's banking system is the worst. It's 30% bad loans. I mean, they're totally and completely bankrupt. Let's see what else. All right, this is a very nice. What's target 2? Target 2 is the ECB's mechanism where one central bank, let's say the German central bank, lends money to the Italian central bank or to the Greece central bank. If you have a positive balance, it means that you're a lender. The central bank in Europe is a lender, and if it's a negative number, this means that the central bank is a borrower. So the Italian central bank and the Italian central banking system has huge debts. So they have accumulated. Germany is owed, again, a record of 800. That's a $1 trillion. And Italy owes 430. This is additional extra debt, debt of the central bank and debt of the commercial banking system on top of Italian government debt, which is extremely high, okay, and other regular banking debt. So again, Italy totally, completely bankrupt. Now, how it's still not gone bankrupt, we know. Mario Draghi just keeps giving them hundreds of billions of euro. They just print them and they just give it to them. And they take it. Of course, it's recorded as a borrowing, but nonetheless. That's why, because of Italy, and of course, Spain, when eventually the European banking system blows up, it's the euro, the currency, that will crash significantly, which is, just a reminder, an example of exactly what happened in 2008 when the global financial crisis came, when banking systems around the world collapsed. This is what happened with Iceland. The Icelandic banking system collapsed. The government tried to bail it out. The government itself went bankrupt, and the result was that the Icelandic krona crashed like 5 times, okay? And of course, they shut all banks down, and people couldn't get any money at all, okay? And that's what is in store for the euro. Again, euro was nice, good, solid currency, better than the dollar until 2011. With the Greek financial crisis, Mario Draghi just doubled the money supply in 2 years and then quadrupled it in 2 more. Euro is now just as bad as the dollar and probably worse. Next. Oh, next is the true, genuine insanity. Chinese central bank has barely 4 trillion of assets in 2004. By 2008, they've gone up to just about 6 or 7. And now take a look. From 2008, from 6, they've gone all the way to, read it for me, 30. They've increased their balance sheet 5 times. The Chinese credit system is in complete overdrive. For the 2017, the statistics were the following. In 2017, the Chinese credit system created more credit than all of US, all of Europe, and all of Japan together. China alone. Now, China is smaller than the US as an economy. China is smaller than Europe, okay? And China is just about the same as Japan. And yet, alone, it created more credit than all the other 3 together. Actually, more credit than the rest of the world together. So on a per GDP basis, these guys are like creating 5 or 10 times more credit than any other financial system, all right? And that's what I was telling Aller the other day. I mean, Chinese are just like everywhere. Everywhere. You go in Thailand, they're spending money like crazy, okay? They're buying property in Cambodia, okay? They're back in Sofia, Bulgaria. They're all over the Middle East, especially in Dubai. And I was telling a story. I go in one of the biggest malls in the world, Mall of Dubai. And you'd expect to see hundreds of Chinese there and not a single Chinese. You walk everywhere in the mall, you cannot see a single Chinese, not a single face, and yet they're in Dubai. It's like, where are the Chinese? And then as I'm walking a couple of hours, it's a huge mall. It takes about 8 to 10 hours to walk it all. I see an army of Chinese storming with their credit cards, all of them raised, the shop for Rolexes. 100 Chinese inside the shop and 50 outside, pushing their way through the door. I finally got my way in, and the picture is very simple. A whole bunch of Rolexes, okay? They take the pictures, send it through WhatsApp or whatever they use. Someone on the other end in China sends back the message by number 3 or by this one, and they go, I take this one. Credit card paid. Next one, this one. Credit card paid. They're cleaning out the shop. Why? Well, these guys obviously didn't work for the money. A cheap, super cheap, dirt cheap Rolex is 4,000 euro. Average Rolex is 10,000. The expensive ones are 50,000, 100,000, okay? So nobody buys $20,000 watch if they worked for the money. They have just good, honest job, you know? You don't do that, you know? You buy the money if you borrowed money, if you're whatever, it's somebody else. You know, people don't spend. And these guys are all in the Rolex shop. Something's horribly wrong when you see people buying Rolexes. Let's see what's else. So this is, okay, bank assets. Chinese total debt. Well, you see, since 2008, they've had roughly 7 or 8. Now it's 25. Okay. In other words, Chinese debt has increased 4 or 5 times. It's going parabolic, and that's in US dollars converted. All right, this is a different picture, just telling you how Chinese debt is going as a percentage of GDP. Before it's parabolic. But as a percentage of GDP, it sees, especially in the last 3 or 4 years, it's gone way beyond insanity. When a government debt gets into the range of 80, 70, or 80%, it's crisis time. When total debt in the economy goes up to 150 or 200%, a country can't get out of it without a major crisis. Chinese have gone and pushing close to the 300% already. Let's see what else I got in here. Oh yeah, Chinese bond market. You see slow, steady rise. Again, that's a lot of credit in terms of China. That's insane. And yet you see in 2015, Chinese credit going parabolic from 10 to 20 in less than 2 years. Corporate credit literally doubles. Where are all these billions going? They borrow the money, the company borrows the money, then moves the money out and buys property in Thailand or in Cambodia, or where else is the money going? Rolex is in Dubai. That's where it goes. This is what corporate debt is. When these corporations, you know, they have no chance of paying this money back. This was never meant, this money, to be paid back. This is money that goes out of China, is never coming back, okay? This is money that when the time comes, the Chinese banking system will just implode on itself. Let's see what else. Okay, Chinese debt bubble. Let me see. Okay, this is cost in terms of credit. Okay, you can see US bank credit relative to Chinese, US bank relative to Chinese, and then you see what's happening in 2011. China and Chinese credit begins to outgrow and overshadow America. Now, 2011, 12, 13, the Chinese credit and banking system generates more credit than the US system. And then there is Chinese shadow banking system, probably no time to explain, but yet another mechanism for trillions of dollars. Don't want to get into that. And now, moving on to from China, so I did a little bit of real estate, a little bit of stock market just to show you how things are going. I showed you a little bit of China. Now this is the rest, the emerging market junk bond yields. In other words, you're in the emerging market like Russia, Brazil, India, Thailand, Cambodia, okay, this is the emerging market, okay? And you see, you get the crisis and interest rates go sky high. Now, again, see how interest rates are going down, down, down. And you can see you can lend and you can barely get 5% from a highly risk, undeveloped or poor, relatively developing country, less than 5%. Again, this is extremely low. It cannot possibly compensate you for the risk. And this is the lowest we've ever seen. Now, junk bonds, you see, these are junk-rated government bonds. In other words, some governments just issue junk, like Venezuela, all right? I mean, the government's just totally, completely bankrupt. And you got a lot of governments like, I don't know, Kazakhstan or some other stand, you know, they're Azerbaijan or whatnot, you know, which don't really have any good credit. I mean, these are governments that habitually default. They just don't pay back, okay? They don't care about paying back. And now you see what's going on in the last, now you see in 2006 and 7 there was some peaks. Again, in the 99 there was some peaks. Now governments issue junk bonds totally, completely out of control. In other words, investors can barely get 2% from the US government, can barely get 2% from let's say, junk bad companies, high-risk companies in Europe. So what they do, they lend to Mexico, Colombia, okay? And this credit has gone parabolic in the last couple of years. In other words, as long as you're a bad government and you promise a high interest rate, you get to borrow the money. Of course, probably you're not going to pay back, but that's okay. Let's see. And this is the emerging market debt universe. Again, you see what was the level in 2000 in trillions of dollars. They barely borrowed $1 trillion. You see up to 2008, they were at 4. You see how much worse things are. In other words, before in 2008, it was only the developed world that blew up. Now, it will be not only the developed world, but also all of the emerging markets. Emerging market is the same as developing world. Let's see what else we got. All right, long-term government bonds. Well, from 1980, you see government bonds been going down, interest rates down and down and down and down and down to historic lows. Well, no wonder if, you can barely lend to a lot of European governments for 1%, that you'll try Mexico or Kazakhstan, okay, or Uzbekistan or some other stand, Pakistan, right, for a little bit more. In other words, this is, policy of extremely low interest rate which pushes investors into risk. And this is the picture for 5,000 years of recorded history. And back historically, interest rates annually between 10 and 20%. This historically. And during the gold standard on gold, it's barely around 4%. But now things are literally down to 0. That has never been. Now, during the Great Depression, there was a short period where interest rates touched close to 0 for a short while. But now we've been pegged to 0 for many, many, many years. That's where a lot of the problems, that's the root of the problems. When interest rates are 0, people start doing crazy things like buying real estate at 2% return, okay? But that's a different topic. Let's see. And this is the same picture, but it's just blown out for the last 200 years, from 1800 until today. It shows a little better. Again, 1938 or 9 was a one low, and now we're just about there and getting lower. Let's see. This is the initial absurdity I was talking to you about. Negative interest rates, like in Switzerland, like in Germany, okay? You lend 1,000 to the German government, 1,000 euro, and the German government promises and will pay you back in 5 years 980. Why would you ever do that? You can just keep your money in the mattress, okay? You can just spend it, right? Buy gold, right? Buy jewelry, buy something. Why would you lend it 1,000 to get 980? This is what's happening now. And now we have 5 trillion. Recent last estimate was that $9 trillion worth or euro worth of credit is earning negative interest rates. Total financial absurdity. Who would possibly do that? Who would lend 1,000 to get 990 or 960 in 5 years? It's beyond comprehension, okay? Next, investment grade yields. Well, that's where the problems were. Investment, let me see, I need to read this one. In 2007, okay, in 2007, before 2007, investment yield grades were earning mostly 4, 5, and 6%. That's what people could get. Now they could get mostly 1 or 2%. Now you can't get 5, you can't get 6, you can't get 7 these days, okay? That's why people are desperate lending money to some poor countries like Nigeria, right? Countries with civil wars, okay? Syria, and so on. All right, so this basically tells you if you're an investor, you cannot make decent, honest return of your own. All right, now, I've been reading, and everywhere in the media, you hear the same thing over and over again, that since 2009, the world has been deleveraging and deleveraging, and global debt is going down, and that the banks are deleveraging. Nothing could be further from the truth. It's just a media story coming from major fake media. Reality is very different. This was the credit level of 2007, right before the global financial crisis. In 2012, the level is much, much, much higher. And in 2017 is even higher. In terms of debt, in terms of leverage, okay? The world banking and credit system is getting bigger and fatter and clumsier. And we know for sure when this blows up, it's going to be so many times worse than this one. And we know this one ended fairly catastrophically for the world. And now it's just a whole lot worse. Again, so I showed it first the real estate picture, then the stock market picture. Now I'm giving you the bond market picture and the credit picture. Let's see what else we got. Oh, okay, CLOs. These are collateralized loan obligations. These are, you package them, you securitize them, you take a lot of junk, you mix it up together, you do financial chemistry, and then you have AAA securities. That's how the world got into the global financial crisis, because it was taking these subprime junk mortgages, okay, in the US, it securitizes them and then sells them in nice AAA securities. Well, that thing was going parabolic right before the global financial crisis. Everybody understood clearly that trillions of these blew up, and these were behind what drove the financial market, financial systems down. And that's why in 2008, that's before the crisis. In other words, that's very high level. But in 2008, that thing stopped. 2009, 10, 11, nothing. Now we're back to even higher levels. The 2017 is very high, and by the end of the year, we expect it to be way, way worse. This includes in student debt and all sorts of auto loans and credit card loans and all sorts of stuff. Now, things are here again, one other corner of the world way worse. Let's see what else I got. Now, derivatives were bad in 2008. They're still even worse. And since 14 and 15, they've gone even worse. Again, this should be, let's see, record low fear. That has to be volatility. Volatility, or VIX, is the index for volatility is the index of stock market implied volatility, which is an indicator of fear. If the stock market is calm, the volatility is very low. If the stock market is in fear and it jumps up and down, the volatility is very high. Volatility spikes a lot during crisis. For example, the Russian financial crisis, that's 1998, and before that, 97 is the crisis of long-term capital management, the LTCM crisis. There was one major spike. It got a whole lot worse, and it spiked huge. There was another little dot-com bubble burst. There is one spike. There is a 9/11 huge spike. In other words, very high means fear, craziness going on in the markets. Very low means everyone's happy, times are good again, investors are buying like crazy. Again, there was in 2008, went very high. Again, this is the flash crash over here, another drop over here, and now we have the VIX at all-time lows. It's like 2008 never happened. It's like these are, according to investors, the best of times in financial history. And all I've been showing you is the exact opposite. We are on the verge of another Great Depression, yet the stock market thinks that everything's perfect. Now, VIX short interest, that's a big topic. I don't know how much more time I have. People are shorting the VIX. And as they short the VIX falls. As the VIX falls, everybody feels more comfortable. They buy the stock market. The stock market goes up. And as the stock market goes up, the VIX falls. And it's a feedback mechanism, which I'll probably need a lot of time, which I don't have to explain. But again, it simply means investors are betting that the stock market will keep going up and that there will not be a crisis anytime soon, okay? And others are betting at the same time that something, that the financial system is about to blow up. In other words, we have a whole bunch of people on the one side believing that everything's perfect, and we've got a whole bunch of people on the other side believing that the stock market or the world is just about to end very soon. We've never seen so much. That's what the short interest telling you. People betting that something's going to go horribly wrong with the financial system. Let's see what else. All right, this is the positive feedback mechanism. I don't know how much more time I have, probably not much time. Essentially, volatility, here it is. Essentially, volatility falls. They short the volatility. When you short the volatility, volatility falls and market rises, and then volatility falls. And it's a feedback mechanism. Risk parity, I don't want to do that. I think that's pretty much my summary slide. Summary slide is, you saw real estate extremely overvalued. You saw the stock market overvalued, significantly worse than 2008. You saw the bond market much overvalued and significantly worse than 2008. You saw monetary policy gone completely crazy. You see bubbles everywhere except commodities. Notice I never mentioned anything about gold and commodities. These are cheap. Rice is cheap. Oil is cheap. Gold is cheap, okay? So commodities are actually cheap. And they have a bunch of feedback mechanism in force. And the markets are usually strong until they crash. I did not cover student debt. Didn't even bother to talk about it. It's still $1 trillion. I didn't cover auto debt, still over $1 trillion. I didn't even cover the flash crashes. I didn't even bother to talk about the high-frequency trading. I didn't bother to talk about too big-to-fail banks, which before, when they were big and crashed, the government bailed them out. They're now a whole lot bigger. I have not said anything about the rating agencies. Didn't talk about the risk under prices, and I didn't even talk about ETFs. In other words, I did not have much time to cover all of these topics, which could have taken a few more hours. But I tried to give you the big picture. And the conclusion is, it's worse than 2008. Timing of the crash is unpredictable. I can spend 2 minutes to explain why. We can't say, is it going to be within a month, or within 3 months, or within a year? Timing is hard in a complex system to predict when it's going to occur. Market could literally, stock market, underperform for 2, 3, or even 4 decades, just like Japan. The Japanese market was 40,000 level in 1990. Now, 30-some years later, it's at 22. In other words, for 30 years, stock market's been down, 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 and down, and down. Okay? And in a crash scenario, gold is pretty much the only safe investment. Not real estate, not bonds, not stocks. And here is, let me see, what happened to gold during the global financial crisis. Let me see, where's the gold price here? Okay, gold price. And again, gold price held steadily. All other stuff went down, and then gold prices started moving steadily higher. In other words, during and especially right after the global financial crisis until 2000 and whatever, 11 or 12, the problems were solved, gold was by far the best performing asset. In general, you could and you should expect when the time comes that gold is typically and usually during financial crisis the best performing asset, the safe haven, the one asset that will save you the most. Because real estate could fall 5 or 10 times easily. That happened in Argentina during the Argentinian crisis. It happened in Japan, fall 5 times. During the Great Depression, real estate fell 10 times, okay? So real estate can easily fall 5 or 10 times. Stock market can easily fall 10 times. Gold is the only one that holds. And during a crisis, government bonds don't hold. A lot of governments just go plain bankrupt, okay? So there's nothing that holds like gold during a financial crisis. And I think that's it. I'm done. Thank you.
For me, it was one of the best economical presentations what I have ever heard. And I use my position here to ask first questions. And can you tell, my question will be one word, and maybe you can tell something about cryptocurrencies.
Oh, okay. All right. Let's turn on another one. Okay. So, question about cryptocurrencies. All right. Well, cryptocurrencies have gone up, 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 and up. Anywhere, anytime, any financial expert gets the question, including me, what do you think about cryptocurrencies? Okay, and that's very, very important to understand and make a distinction between Bitcoin and the cryptocurrency technology. The cryptocurrency technology, as a technology, it's called the blockchain technology, is a bright, brilliant future. It will change and revolutionize the world similarly to what the internet did. But it doesn't mean at all that it will be Bitcoin the winner. We have now Ethereum. We have 1,000 digital currencies so far. We expect another few thousand digital currencies more. Now, out of 1,000 internet and .com stocks, we now have barely 10 survivors. 990 went bankrupt. With digital currencies, we already have 1,000 digital currencies. I cannot know which the winners are. You could be a millionaire if you would know which digital currencies will be the winner. In other words, don't confuse the technology like internet with .com company like pets.com. Do you guys know pets.com? Pets.com was a company that was supposed to deliver food and take care of all the pets in the world, which went bankrupt just 12 months later. In other words, 98% of .com companies did go bankrupt. Of course, you all know Amazon, okay, making big money. In other words, those that survived did phenomenally well, okay? And most of them went bankrupt and investors lost everything. There is no way to know if Bitcoin will be the one. We already know that Ethereum came back and is doing a whole lot better and faster. But you don't know there's going to be the next currency who's going to outdo Bitcoin and Ethereum. So the technology will be there, but you don't know which one is the winner. Yeah, you can try and maybe invest in 10 and 20, make a portfolio of them, and hope that out of the 20, you will pick 2 winners and make overall some money. Maybe yes, maybe no. Now, the volatility is so high that it will be crazy to put 50 or 80% of your money in Bitcoins or digital currencies. But you want to play? Sure, put in 5% of your money in Bitcoins and Ethereums and whatnot, and keep your others in whatever, real estate, stocks, bonds, gold, whatever. In other words, you can use digital currencies as part of your portfolio. But because of the very high risk, keep it up to 2, 3, at most 5%. If this other answers your question, again, more questions. Is this clarify what I'm talking about? In other words, cryptocurrencies are popping up all the time. If somebody told you that the supply of cryptocurrencies is fixed, they're lying. No, Bitcoin is fixed, but now it's Ethereum. It suddenly doubled. Now I got 3 currencies. So every time you add a cryptocurrency, the supply of cryptocurrencies increases, okay? And right now people are totally and completely crazy about these cryptocurrencies, and we know it's one of the craziest bubbles. In terms of prices, now we're doing a lot of research. They perform way bigger as a bubble than the dot-com bubble. Now, will it burst? Yes, sure. Now, will some of them be winners? Yes, 1, 2, 3%. And if you can pick them, you'll be rich. But otherwise, you're risking a lot. You're risking a lot, so don't put very much. Does this clarify? All right, more questions? Any other questions? Anything else you may have, actually? All right, please.
But why gold should hold up the value so well?
The gold holds up so well. Okay, that's a very, again, that's a very good question. It holds so well because it is outside the financial system, most of it. You keep it in your house, you keep it buried and whatnot. It holds so well simply because the others don't hold well. In other words, stocks don't hold well. They can easily crash 5 or 10 times. In other words, they can easily lose 80 or 90% of their values. Bonds can easily crash. But here's the thing, here's the explanation. When a financial crisis comes, governments do bailouts. They'll bail out the stock market, okay? They'll bail out the bond market. They'll bail out the real estate. Where is the bailout coming from? Short answer, government prints it. But government creates it out of nothing. You saw it here after 2008. That's what the ECB and whatnot. When the government prints and creates money, we know the one thing that goes up with money supply is gold, okay? So gold is a true, genuine value. Now, how do we know, and we are sure, how can we be sure that gold is so valuable and will hold it? Well, you got 500 million women in India desperate to get some gold, and 500 million men in India who are ready to kill for that gold to deliver it to them, okay? You got 500 million women in China eager and desperate to get their hands on gold. They don't give a damn whether there's a recession or depression or what's going on with your stock market or their money. You have about 200, 300 million Arab women who also want to get the thing and put it on their ears and nose and whatever else, you know. In other words, you have a steady, solid demand for gold, which is based on culture, mentality, has nothing to do with stock market, bond market, real estate, and whatnot. You want to get married in India? You got to get the gold, and you got to deliver it, okay? You want to get married in Thailand? You got to have a dowry. And you better have 10,000 worth of gold, which you're going to put on a platter for everyone to see before the marriage, and then put it on, you know. So gold is driven by completely different factors, irrespective of whether Dow Jones and the stock market goes down to pure zero, okay? And is not affected by financial crisis. On the other hand, when a crisis comes, it is by far the safest of them all, simply because the stock market is known to fall easily 5 or 10 times. As I said, real estate can fall 5 or 10. In other words, of all the assets, gold is the least vulnerable, okay? So that's a good answer. Somebody had a question. Yes, please. Yes, please.
Well, I would like to thank you for your exposition, which has been entertaining and informative in equal measure. And I would just like to tap into your expertise to table the $76 trillion question, if I may. And I have put it down in writing for purposes of clarity.
Go ahead.
So basically, the global monetary system and associated capital markets as they continue to exist today developed following the Second World War, when Western economies' economic output as a percentage of global GDP was roughly proportional to Western capital markets' proportion to the global market capitalization.
Okay.
Western countries' reserve currencies, banks, clearinghouses, rating agencies, etc., dominate as facilitators of global trade and capital flows. The past decades have witnessed a radical shift of actual economic outputs moving to emerging markets, especially to the BRICS countries.
Yes, the BRICS, Russia, I already mentioned China, India, and so forth, Brazil, okay.
With no equivalent realignment of global financial system happening yet. So my question would be the following. In your opinion, will the West manage to sustain its dominance of the global financial system? And if not, how will the transition take place, and in what time frame? Basically, if you were a betting man, would you bet for or against such an occurrence taking place in the next decades? And if so, will it be with or without a major war as these?
Oh, okay. All right. The first part of the question is amazingly easy. The West is going steadily down. Politically, economically, socially, culturally, morally, okay? The West is going down. Asia is going, the emerging market is going up. The transition of financial power, of economic power, has already been steadily moving from the West to the East. And China is due for to rule the world. That's economically, financially, and probably militarily. That's also clear. Now, whether the transition will be peaceful or with another major global war, it's hard to predict. Usually those types of transitions are associated with massive geopolitical conflicts. So there is most likely to be a conflict. As the transition shifted, let's say, from the UK to the US, all of these transitions are associated with a financial crash or panic, like the Great Depression, where both America and the UK went down. The UK went down a whole lot worse, and out of it, the US emerged. Similarly, I could guess that when the next depression comes, the US will be down and the China will be down, but Chinese economy will be down a whole lot less and will emerge as the economic leader of the world, simply because all the assets, productive assets, steel, copper, whatever, is in China. The West does not have as many productive assets as East and China. Time framework could be anywhere from 5 to 25 years. Again, it's hard to predict how long economic depression will be. Okay, could be so this transition could be anywhere between 10 and 30 years. That's my intelligent and educated guess, but it's just a guess. Now, the power, financial and economic and military, is shifting from the West, meaning the West is shrinking in itself and Asia is rising. It's easy to observe. It's been going on for the last 20 years. And the best book to read on the subject is Tomorrow's Gold by Mark Faber. Great book on the transition of world global power from the West to the East, or on the decline of the West and the rise of the East.
Täname meie ettekandjat.
Oh, thank you.